Here's the million-dollar question. The understanding is how price moves from one level to the next, but predominantly it's moving from a level of discount to a level of premium, from a level of premium to a level of discount. Between the red line and the blue line, they are extremes. In the middle, that's classified as equilibrium or balance. Buying imbalance is seen when price gets above equilibrium or up into that red level, which would be resistance. Selling imbalance would be when price gets below equilibrium and down into the blue line, or what would be described as discount. So where would you expect to see price go next? When you look at charts, you want to see where price has moved away from an old high and it's dropping down from an area of premium. In other words, it's too high, so the valuation is going to be reduced and dropped lower. So repricing takes place and the market goes down and the price goes lower as a result of it until it gets to a point where it's too much of a discount. Then there has to be a premium built into it. The algorithm will do this, moving price back and forth, back and forth, back and forth, until, again, something of significant impact comes into the marketplace and drives the market one-sided, and it creates a strong imbalance. Otherwise, the market's just going to gyrate back and forth, looking for liquidity based on premium and discount conditions. Your expectation is right now price is at a level where it should, by all standards, move lower because it's at a classic viewed resistance level. We don't know how long that time is going to be required before the market does in fact submit to our expectation and see a lower price. That part is what you're always going to have to submit to. Time is a murderer. It's a killer for traders. Unless you know that some of these ideas are going to pan out for a long, long time, you're going to do a lot of things psychologically and emotionally that you wish you wouldn't have done because you haven't submitted to the time aspect of trading. There's two elements in trading you have to submit to: time and price. When they both agree with one another and you have waited for that agreement to come to fruition, that's where profitability and opportunities are. So we're looking at price, and we have no idea how long time is going to be required of us to wait before the displacement takes place. But eventually, our expectation is we'll see lower prices down to a level of discount. And that's what we're expecting or forecasting as a future price. In between these two reference points, again, time and price is what's essential. You have to submit to the level of time, which no one knows how much time is going to be required before your setup pans out or goes to profitability. Price is what you're studying. You're submitting to time throughout the process, but while you are in the trade or expecting this to unfold, studying it, you're submitting to the price. Okay, for a monthly chart, okay, what you're going to do is you're going to look at the current trading range that it's in. So we're going to assume that you outline the marketplace in terms of old highs and old lows on the monthly. In between these two reference points, the halfway point, this is always going to be referred to as equilibrium. Now, equilibrium between where you think price will go because it's been there before and where it's at right now relative to an old high and old low, that's the current trading range. The first thing above equilibrium in the form of an array is an old high and old low. You want to be looking for that above equilibrium. The next thing that you'll be looking for, and this is in the order of importance, old high, old low, then the next thing you'll be looking for is a rejection block. A rejection block will be just above the candle's body, not the wicks. So the actual high and low is the wick. The next area of importance is the rejection block that would be just above the candle's body. Then the bearish order block, a fair value gap, a liquidity void, bearish breaker, and the mitigation block. If we were at equilibrium and we were moving away from a premium level or resistance, in other words, price has already dropped down, and we anticipate price going lower down to a level of support or monthly discount, we would be looking for above current market action. Again, assuming that we're at equilibrium right now, we would start looking above current market action in the past on the left side of our chart. Where's the nearest mitigation block? There may not be one. Okay, check that off. Where's the nearest bearish breaker? There may not be one of those either. Okay, check that off. But if there is one, then you would reasonably expect to see price trade up to that price point, the breaker. Then expect some selling to go lower And once it moves below equilibrium, then you would be all set to go to the monthly discount or support. But let's assume for a moment the mitigation block isn't there and the breaker isn't there. What would you look for next? Okay, well, the next order of hierarchy is liquidity void. Is there a range that needs to be closed in? Again, that may not be so clear. Check that off, no problem. The next thing, is there a fair value gap? Again, that might not exist either. Go to the next thing, bearish order block. That's probably going to be there. Chances are it's very strong that it's going to be there. A mitigation block is going to be first considered before you get to the bearish order block, because the bearish order block is going to be really high up in the premium. Mitigation block is going to be the lowest. Mitigation and breakers are basically mitigation blocks, but generally mitigation blocks can occur lower than breakers. Small little bounces in bear markets would be a mitigation block, basically. A bearish breaker will keep your ability to get to a bearish order block, which would be resting higher up in the premium. When an old high is taken out, that down candle right before the second high is made, taking out an old high, or turtle soup in other words, that down candle, if it's retraded to, that's going to be a bearish breaker. That's going to keep you from seeing, most likely, high probability that it won't allow you to get to a bearish order block. So whenever you see bearish breakers, just don't expect the bearish order block to be hit, okay? Because it's going to most likely keep price lower, because that's going to be the most dominant array of all these in here. There is a liquidity void that would be viewed if there's no breaker. You can close in that range, and that may take you up into a fair value gap or a bearish order block. Breakers by themselves, even though they're low end on this list, if there is a lack of bearish order block, understanding in what you're looking at currently in market action, because there may be a lot of wicks, something like that may occur, then you would look for a rejection block, which would be just above the body of the candles. You would expect that to be ran out, and then you'd be really high on the premium there, and then ultimately a whole entire run on the old high. Now, I have here old high and old low. Why would the low be there? Well, if you're on a very low end of a downtrend on a higher time frame monthly chart, you may be rallying up to a old low, and if it gets to that old low, even though it's an old low in terms of price, it's really high up in the premium if it's been rallying a considerable amount of time and price to get to that level. But it may need to run out an old high as well. The expectation is when you're looking up in price for areas where price may go up to, it's in this order from the lowest up. In other words, from mitigation block all the way up to old high and old low. The farther you go up in this list, the more deeper you go into a premium market. Certain arrays in here will keep you from seeing the next higher array. In other words, if you get to a breaker, chances are you're probably not going to go higher than that. You won't generally get up in to close that void. If there's a breaker below a liquidity void, the liquidity void may stay open, basically. That range may stay open. You can see here the monthly premium arrays. These are going to be focused for primarily bearish premium array trading. In other words, you're going to be using these areas at which to frame a trade or look for bullish targets at these levels. For monthly discount, these are your bullish discount arrays, and you'll be looking for these for bearish targets or looking to get long at any one of these based on the current conditions in the market.